Are you feeling ignorant about your own hotel's financial well-being? Would you be able to detect danger signs in the financial health of your hotel? Were you aware that picking up these danger signs in your hotel's financial well-being is a critical skill for a hotel manager, and it is guaranteed to get you elevations and promotions, ultimately success. However, most hotel managers have no understanding of the financial health of their hotel. Ability to detect early warning signs is actually a leadership strength. But most hotel managers tend to ignore this critical leadership strength. Because of that, their promotion and elevation opportunities become limited by their own actions. I will show you how you can easily identify early warning signs of your hotel's financial health. You would want that, right? And we'll be using a very simple technique. However, your peers would not know about this, so you will have a head start on them. And this technique will boost your chances for promotions, elevations, and all kinds of opportunities. Now, you may have a question. Why me? I spent 26 years in the hotel industry in senior finance and leadership roles. I have myself detected hundreds of early warning indicators. Moreover, I have personally shared this with hotel managers and got them to identify them too. And that led to successful analysis and successful financial decisions. What if you were tipped off about a negative business performance circumstance, what I call early warning signals, particularly if it's about the long-term surviving capability of your hotel? It boils down to the question whether the hotel can survive in a long-term situation. Solvency ratios do just that. They are early warning signals. But first, what are these ratios? Now on to the most critical solvency ratio of them all, the mother of all solvency ratios, you could call it, the net worth ratio. It's a solvency measure that uses the total assets of a business and the total liabilities, and in this particular case, the assets and liabilities of your hotel. But what is solvency? Well, it is all to do with the long-term health of your hotel as a business. You could also say it's the ability of your hotel to survive in the long term. Now, a hotel generally needs to run its operation and stay in business. In other words, be solvent. Solvency ratios are about remaining in business. Now, assets provide solvency to do just that, but only after you have paid off the obligations of the business, known as liabilities. And that is the net worth ratio story. Let's now understand what these assets and liabilities are, which are part of the net worth ratio story. The net worth ratio story begins with the formula to calculate the ratio. So what is that formula? Let's take a look. We will be using the 31st December 2018 numbers to calculate net worth ratio. Begins with total assets, as you can see, marked number 1, less total liabilities, marked number 2. If you use the numbers in this formula above, you end up with 420,000 as your net worth ratio. But you may have a question. What does this net worth ratio of 420,000 actually mean? Great question. It actually means that your hotel has $420,000 worth of assets left after paying off total liabilities. In other words, you could say net worth ratio is reflecting the net total assets. Net worth ratio in the current instance is reasonably good. How did we say that? Well, total assets here are 39% higher than total liabilities. In other words, the total assets of 420,000 are fairly good. Now, let's see the situation in the following year, as of 31st December 2019. The same formula, total assets less total liabilities, and when we take the numbers, we arrive at 517,300. That amounts to total assets being 44% higher than total liabilities. This is definitely better than 31/12/2018, and so the net total assets have improved. What is the concept of net worth for a business? Well, the business worth is all about what is being owned and what is being owed. Owning is all about total assets, which we saw in the formula, and owing about total liabilities, which also we saw earlier. Net worth tends to be the difference between owning and owing, or assets and liabilities. In other words, net worth equals net total assets. In this case, 517,300 as of 31st December 2019. Now, total assets and total liabilities for a business, as you can see the numbers below. Why are we using assets and liabilities? Because assets will be used to pay off liabilities. And then whatever is left as a balance are known as net total assets. So in a way, the net worth ratio equals net total assets. What is the most important litmus test, or what we call a testing principle for a business as far as its worth is concerned? Well, the first thing is your net worth ratio negative or positive? That means, are assets more than liabilities, or the other way around? Are your total net assets positive? Above, we can see that they are indeed positive. Now, the more positive the net assets are, the more your business is sustainable or can survive in the long term. You would want to know that, right? Well, let's take a closer look at what are included in total assets and total liabilities for a business. So what are assets? Assets are part of the balance sheet, which is one of the most important financial statements, and assets are what the business owns, right? Like current assets, investments, property and equipment, etc. Assets also indicate solvency, as we saw earlier. Solvency basically means survival capability. Now, assets can be of two major categories. They can be current assets, as you can see here. Current assets are simply assets that have a life less than one financial year. In other words, they get used up during a financial year. Number two, assets can be long-term. And long-term assets are assets with a life beyond one financial year. Long-term assets are also titled as property and equipment. They're commonly known as fixed assets. Let's learn more about current assets now. Current assets, as you can see, are assets which are also considered liquid. What is liquidity? Well, liquidity is simply the ability of an asset to turn into cash. And here you can see the first item in current assets is cash, followed by short-term investments, accounts receivable, inventories, and prepaid expenses. One critical thing to understand is current assets are listed in the order of liquidity. The most liquid asset first, the next most, next, and so on. So you can see that cash, which here is shown by 1A, is the most liquid asset. You don't need to convert into cash because it's already cash. Now, current assets are used to pay off current liabilities, which we saw earlier. And one of the most important financial ratios is a ratio called current ratio, which uses current assets and current liabilities. Let's now understand current liabilities better. Now, the current ratio, as we saw earlier, takes into account the formula current assets divided by current liabilities. In our case, where we use the numbers for 31st December 2019, we arrive at a current ratio of 1.58. That means you have 0.58 times current assets more than current liabilities. So here, current assets of Paradise Hotel are pretty liquid. But are all of Paradise Hotel's current assets equally liquid? Let's take a look. Each current asset actually has different liquidity levels. Cash, as we saw earlier, is the most liquid current asset. Important fact that we noted earlier is the order of current assets. Current assets are listed in the order of liquidity. As you can read, most liquid first, and so on. And so cash is at the top of that list. Now, let us see Paradise Hotel's other current assets and their liquidity. Short-term investments are next in line. Short-term investments are simply investments made to earn an income. Normally, it's outside the business. And short-term is like what we defined current earlier as anything within one financial year. Let's now look at accounts receivable. Accounts receivable is a very critical current asset. It's the next in line in liquidity. What is accounts receivable? Well, it's sales made but money not collected. That's what accounts receivable are. Now, accounts receivable need to be managed so that the cash flow is positive, because when you collect the accounts receivable, cash flow improves. Now, let's take a step back and look at current liabilities. These are the current liabilities we can see in the Paradise Hotel balance sheet. Now, you notice that the current liabilities have increased 2019 over 2018. That means in 2019, you actually have more current liabilities to pay off. But the current ratio, which we saw earlier of 1.58 for Paradise Hotel, is reasonably good. You have much more current assets than current liabilities. Now, let's see how working capital is better. Working capital is nothing other than current assets less current liabilities. Let's take a look at the numbers. These are the current assets numbers. These are the current liabilities numbers. And deducting the second from the first, that is current liabilities from current assets, we get working capital, which over the 2 years are so. You can notice that 31st December 2019, the working capital has really jumped up, which is a good sign. Now, because current assets have increased more than current liabilities, the working capital is better. Let's now see what's included in current liabilities. First item is accounts payable, and these are the numbers. What is accounts payable? Well, accounts payable are simply what Paradise Hotel owes its suppliers for goods and services rendered. Now, generally, the suppliers allow 30 days for payment, so accounts payable indicates how much needs to be paid for current liabilities. Because accounts payable has increased, as you can notice, 2019 versus 2018, more current liabilities need to be paid off, as we noted earlier. Next item is accrued income taxes, and these are the numbers. What are accrued income taxes? Well, they are monies owed to the Inland Revenue Service for income taxes to be paid for the hotel's income. And the next in line is accrued expenses, which are broadly estimated expenses paid by Paradise Hotel. Let's look at the last item in current liabilities, which is unique. It's called the current portion of long-term debt. And the numbers are as follows. Now, this current portion, what is it? What is it as a current liability item? Well, it is what Paradise Hotel owes in the next 12 months out of the mortgage amount total. So current portion, as you notice, has increased in 2019 versus the previous year, means installments are either not paid or maybe another loan taken, both of which are not really good indicators. We saw how assets can be current and or long-term. Long-term assets, we also noted, are known as property and equipment, or commonly called fixed assets. Let's take a closer look at these fixed assets. You notice the property and equipment, which represents fixed assets, is shown here, and there are three items here: land, buildings, furniture, and equipment. Property and equipment are fixed assets which have a life of over 1 financial year. So land is an immobile property included in that. Buildings are the next in line, and furniture and equipment the third in line as far as the property and equipment are concerned. The next item is a very important item which we will learn about in another video, and that's depreciation. Depreciation is simply wear and tear in your property and equipment. Deducting total depreciation from the total of the property and equipment, you get what is known as net property and equipment. Net worth ratio, as a reminder, uses total assets and total liabilities. Let's now look closely at total liabilities other than property and equipment for Paradise Hotel. Notice the total liability numbers as below, as of 31st December 2019 and 2018. Total liabilities have actually increased, which, as we noted earlier, mean more liabilities to be paid off in this year, 2019. Now, let's see why the net worth ratio improved from year 2018 to 2019. These are the numbers. We see total assets, we see total liabilities over the 2 years, and the net worth ratio is simply total assets minus total liabilities. That net worth ratio, as you can see, has improved from 420,000 in 2018 to 517,300 in 2019. Because total assets have increased more than total liabilities, the net worth ratio has improved. So we said we will look at what's included in long-term liabilities, and let's take a look at the couple of items there. Mortgage payable is the first item, And these are the numbers. What is mortgage payable, by the way? Well, mortgage payable is what Paradise Hotel has borrowed from outside parties or third parties, mostly as a term loan. Now, term loan is normally secured by a mortgage on the hotel's assets. So if there is any default in the payment of loans or interest, then the lender can take over the property assets. Now, mortgage payable is also known as debt as in long-term borrowing. Notice that mortgage payable actually has decreased 2019 versus 2018. It simply means that the loan has been paid off partially. Next item is deferred income taxes. And these are the numbers. What are deferred income taxes? Well, deferred income taxes are taxes owed to the Inland Revenue Service beyond the current year. So you could say that this is a tax liability deferred to the future. Now, these are over and above what is owed to the Inland Revenue Service in the current year, which actually goes into the income statement. Let's now take a recap of the net worth ratio. Always compare net worth ratio year on year, 2018 versus 2019. Make sure that your total assets are higher than total liabilities, that your total liabilities are not increasing over the 2 years while they are here, but you need to investigate why so. And ensure that the net worth ratio generally reflects that assets are at least 100% more than liabilities. So what are the 3 key takeaways of the net worth ratio? Number 1, the formula is that it is total assets less total liabilities. The second item is keep total assets at least 100% higher than total liabilities, and also ensure that the net worth ratio is increasing year on year. Now, that is about net worth ratio. Would you want to learn more about the power of hotel financial ratios, other more important ratios related to net worth? Watch this video on the ultimate guide on hotel financial ratios.